Big news today. Soho House, the ultra-exclusive private members club known around the world, is going private again in a massive $2.7 billion deal. Yep, you heard that right. One of the most famous lifestyle brands, home to celebrities, entrepreneurs, and influencers, is leaving the stock market and heading back into private hands. So, what does that really mean for regular people and for investors? Let's break it down in plain English. Soho House has always been more than just a place to grab a cocktail. It's a brand built on exclusivity, luxury, and cultural cachet. But running a high-end global club business isn't cheap. The company has been carrying debt, facing investor pressure, and struggling with profitability. Even though the brand has strong recognition, Wall Street hasn't been totally convinced about its long-term money-making power. Shares were trading under $9 recently, a far cry from what early investors once hoped. Now comes the game changer. A group led by MCR Hotels, a major U.S. hotel owner, has struck a deal to buy Soho House and take it private. Investors will get about $9 per share in cash. For shareholders, that means no more roller coaster stock price. For the company, it means fewer public headaches and more flexibility to run things behind the scenes. But here's where it gets even spicier. Ashton Kutcher, yes, the Hollywood star and well-known tech investor, is joining the board after the deal closes. That puts a celebrity face directly into the business side of Soho House. It's not just about glamour. Kutcher has a solid track record in startups and hospitality investments, so his presence could signal a real growth strategy. Why does private ownership matter here? When a company is public, it has to report every quarter, answer to shareholders, and live under the spotlight of Wall Street. That can be brutal for a lifestyle brand that wants to expand carefully, protect its exclusivity, and try new things. By going private, Soho House can refocus on its members and long-term strategy without worrying about the stock dropping every time earnings disappoint. Of course, this deal isn't without questions. Some shareholder law firms are already investigating whether the $9 per share price is fair or if the company could have gotten more. On the flip side, for investors who've been stuck watching the stock struggle, cashing out near $9 might feel like a decent exit. Let's also talk about the money behind the deal. MCR Hotels is one of the largest hotel owners in the U.S., managing properties all over the country. Adding Soho House to his portfolio gives MCR a lifestyle and luxury edge that traditional hotels can't always pull off. Think about it. Exclusive members-only clubs tied into a hotel empire could create a powerful hybrid model, steady hotel cash flow, plus luxury brand prestige. And Soho House itself still has a strong footprint. The company operates nearly 40 houses worldwide, from New York and Miami to Barcelona and London, and beyond. Membership fees aren't cheap, but demand remains high. In fact, waiting lists in big cities stretch into thousands. That's the core strength, exclusivity. Members aren't just paying for drinks or rooms, they're buying into status and community. Still, investors always worry about the balance sheet. Running lavish properties in prime locations is costly. Debt payments pile up, renovations, expansions, and maintaining the cool factor all eat into profits. That's why going private could help. The company can restructure quietly, test new strategies, and even cut or raise membership fees without Wall Street breathing down their neck. Now, let's zoom out a bit. This isn't just about Soho House. It's part of a bigger trend. Private equity firms and hotel groups are scooping up lifestyle and luxury brands. Why? Because experience-driven hospitality is where people are spending. Travelers want more than a bed. They want identity, exclusivity, Instagram-worthy moments. Soho House fits that bill perfectly. But here's the catch. Exclusivity is hard to scale. If you open too many locations, you risk watering down the brand. If you don't expand enough, you limit growth. That's the razor's edge Soho House has to walk. And now, under private ownership, it'll have to prove it can manage both sides. For members, not much will change immediately. Your favorite Soho rooftop, spa, or screening room isn't going anywhere. But long-term, members could see upgrades, new locations, or even new rules for who gets in and who doesn't. Remember, the brand's value comes from keeping things selective. For employees, private ownership may bring changes in leadership, strategy, and culture. For investors, it's the end of the road. Your payout is set at $9 a share. If you believe the brand could one day be worth a lot more, you might feel disappointed. If you've been frustrated watching the stock lag, this deal probably feels like a relief. And let's not forget the celebrity factor again. Ashton Kutcher's presence on the board isn't just a PR stunt. His network in Hollywood, tech, and hospitality could help Soho House grow in smart ways. He knows the value of brand equity, and he understands how to turn exclusivity into money. Don't be surprised if you start seeing new collaborations, tech integrations, or even celebrity-backed expansions. One last thing, the price tag. $2.7 billion is no small sum. That shows serious belief from MCR Hotels and their partners that Soho House has untapped value. The big bet is that, away from Wall Street's quarterly scorekeeping, they can grow membership, improve margins, and maybe one day bring the company public again at a much higher valuation. So here's the takeaway. Soho House going private is about more than just money. It's about control, brand, and strategy. It's a reminder that not every business fits neatly into Wall Street's quarterly cycle. And for a brand built on mystique and exclusivity, maybe life is better behind closed doors. What do you think? Was this a fair deal for shareholders? Will Soho House thrive under private ownership? Or is this just delaying more tough times ahead? That's it for today's breakdown. If you found this useful and want more clear takes on the biggest business moves, make sure to hit like, tap subscribe, and ring the bell so you never miss an update. Thanks for watching, and I'll see you in the next video.